You have all of the Asian markets which are in the red, all of the global markets in complete risk off.
In terms of all-time high, the quarterly ROA and quarterly ROE are at all-time high.
So the next support for the Nifty Bank stands at about 43, just under 43,200.
Well, there is another 5% downside risk, and that's the likely sector to take the market back to at least that 19,100 area.
But let's take it straight to the market opening now. Is very, very flat.
Probably September and October, pretty much every single market has seen outflows.
Prices, I think on an absolute number, may go up by $25 to $30 per ton.
In my calculation, we should be crossing anywhere between 725 to 735 tons of silver this year.
The analysts estimate that there will be a 4 to 5 times jump in their tariff revenues.
Another day when the mid-cap and the small-cap index is under severe pressure.
Yeah. EBITDA is also up 62%.
Party workers are upset, and the reason here is that they're not happy with the ticket distribution.
You're seeing clashes across Israel's border with Lebanon.
It's a sharp, sharp cut that you're staring at for the mid-cap index.
Well, that was the day so far. You're with us here on an early edition of Closing Bell. We are coming to you live from the CNBC-TV18 Motilal studios. I'm Prashant on this big wall, and with me are my colleagues Reema and Surabhi, who are here right here in the studios with me. And of course, Nigel is joining us from the newsroom floor as well. Guys, hi. Good afternoon. You got a bit of a problem on hand, which is the problem of the fall in mid-caps and small caps that we are seeing. And I just want to take exactly 40-50 seconds to capture what I'm talking about. So it's a down day, as is very, very visible, I think, for anybody who's looking at the markets. And purely sort of quantifying this, on mid and small caps, this is the worst day we've seen since the 12th of September. Now, what happened on the 12th of September? Both these indices basically sold off 4%. Today it is, actually, it's not even close to what we saw that day. That day was complete carnage. It's more like 2%. And, with bounces, intermittent bounces, which kind of, reduce that cut. So, but in any case, it's the largest sell-off since then. Market breadth is deeply negative. I saw some 300 stocks down and some 300 stocks higher and 2,000 stocks lower. There you go on your screen. Actually, 27 to 300 is the ratio. Lots of actively traded stocks are down over 10%. If you just sort the list by percentage, you'll see lots of 20%, 15% cuts. But the point is, you got to look at stuff which is going down on volumes, right? So just a few prominent ones on your screen. Laurus, you've got, and this is, by the way, a list of stocks which have disappointed earnings, consensus earnings expectations. And this is just what came to my mind over the last couple of days. Laurus, Havells, Emphasis, Kajaria, Voltas, Astral, and a bunch more. So, the point is mid-cap earnings broadly have not been all that great. At the margin, perhaps there have been some disappointments. And if you want to see which have been the really big positive earnings surprises, actually, it is only Bajaj. Polycab, maybe, but Polycab, compared to growth in the first quarter, Q2 was actually slower. So that's what we're working with. Polycab, by the way, was also, of course, a big blowout in Q1. But the list is much smaller, and disappointment so far in terms of what we're tracking is longer. So then the sell-off on your screen in terms of what we're seeing, Amber is down 7.6. Again, I'm only looking at the more actively traded part of the market. Indiabulls Housing on your screen. Titagarh is selling off. You've got RCF, which is down sharply. PNB Gills, Railtel, BEML. There is, Sequent Scientific, Iron Exchange, which is down 10%. Dwarikesh, Jubilant Pharma, Star Cements, Atul Auto, Raj Ratan Wires, Kirloskar Brothers, Piramal Pharma, and so on and so forth. Not Jubilant Food, but Jubilant Pharma. But so many of these names which are down sharply. But I have to say, and I want to say, so the last thing I want to say here is this, that this is not what we saw on the 12th of September. Back then, it was a pretty steep cut across the board. The list that you're seeing here, well, it's got some 10, 15 names, but it doesn't come close to sort of, the carnage that we saw back then. So maybe there is still hope here. We'll sort of watch this closely. The reasons why the markets are down, of course, it's a global risk-off. And we've been kind of treading water around important support levels, and some of those are starting to break. And we'll discuss more on that here over the next hour plus or so. Reema, hi.
Hi, we're already seeing some signs of recovery.
Yeah.
The mid-cap index at the session lows was down 900 points. We're now down about 700 points, a little less than that. The Nifty intraday low was about 19,404. very close to its 100-day moving average. And from that level, we've seen a bounce of about 25-30 points. Already in the last 30 minutes, it's not that we've recovered, but you can say that markets have stabilized to some extent and they are attempting a bit of a recovery. That said, this is still the 4th consecutive day of decline when it comes to the benchmark index. The broader market, just to put it in context, the kind of fall Prashant outlined very helpfully, all the big names which are weak in trade. But, you know, the advanced decline ratios, Surbhi, I think that's really the problem pocket. We've got about 300 stocks in the green for about 2,700 plus stocks in the red. And if I look at the individual constituents, for instance, the Midcap 100 index, 11 of them are only in the green, 89 of them are in the red. In the Nifty 200 stocks, 27 in the green versus 173 in the red. So predominantly across the big indices in the broader markets, it's the, you know, the advanced decline ratio is 1:9, 1:10, perhaps even worse than that.
Oh, absolutely. You guys have really, illustrated very well what's been happening in the broader markets. Just a word on the big boys themselves. They've not been in the best of health, not feeling too festive, you can really say that, because the Nifty itself has struggled. Now, the Nifty took support, or let's say the day's low was around 19,404. So we've lost the 20 DMA, we've lost the 50 DMA. What's in question now is the 100 DMA. That's where the 100 daily moving average comes in, around 19,400. That's the zone, and that's held, at least for today. We still have an hour to go. Let's just pull up the contribution plate. That will tell you that barring ICICI Bank, there's no stock really contributing meaningfully on the upside at all. It's a down day for large caps as well. And there's plenty of pressure cutting across lines. I mean, banks are weak. Kotak, of course, has the specifics around the numbers that came out. But you're looking at some other names from IT, for instance, TCS, Infosys. They've been quite weak. Reliance is on the downside, pulling the index down by about 13. And you can see the real meaningful contribution is only coming in from ICICI Bank. It's weak. Nigel, I guess we can only hope that at least if the global market stabilize, there's no further big selling pressure in the next 1 hour, then at least maybe our lows of the day hold.
Well, that's right. And actually in this sort of a market, there are select stocks that are giving 1%, 2-3% intraday downtick, and they're getting lapped into. Case in point being a BSE. That stock intraday has fallen a little bit and it's quickly getting latched onto. Credit Axis Grameen, well, those numbers look good. The guidance has been up. And the stock, with the markets down, that one is up close to around 9% as we speak. So good going out there. Ipca Laboratories, that, good news coming in with regard to the Ratlam facility. So that stock continues to hold in the green. The short point that I'm trying to make is, there are select stocks that are still taking note of, either numbers or positive management commentary. Balkrishna Industries, and that one is up close to around 2% as we speak post their con call. Big recovery is what we've seen even out there. And Genius Power as well. So yes, the markets are under pressure, but select stocks with themes, with good numbers, good commentary, well, they have reacted positively as well as we speak. Balkrishna Industries currently has moved to the high point of the day. So the market is still looking out for ideas, looking out for good stocks that they want to buy. But the broader sense is today is a bit of a, a lot of portfolios will not be feeling too good. How do you position yourself, though, for the final hour of trade? Mitesh Thakkar is back with us. Well, Mitesh, we're holding around that 19,420 odd. What would you do on the index? I think earlier today you were looking at that range of 19,450 to 19,750. At current reckoning, what is the call?
I think, good afternoon. Earlier, I think, the Bank Nifty was holding well. And once the Bank Nifty started correcting, I think there will be some pressure on the Nifty. Now, both the indices are getting closer to their medium-term support levels. 43,400, 200 area, which is also the 200 average for the Bank Nifty. So this 43,400, 200 range is also a weekly pivot and the 200 moving average area. So I think that's the key level to watch there. Nifty, I think it's broken that 19,450 pivot. I mean, at least it's trading below that. But there's a good chance that we might see the Nifty index, try and take support around the August lows of 19,230, 200 zone. So, I think both the indices to me look like testing those levels. And if we start breaking below that, then we might get in a deeper or a slightly faster kind of a correction. So the overall setup is on the negative side. So it remains more of a sell on the rally kind of a market. On the stock side, I have one buy and one sell. Hindalco has broken down. So that's a sell with a stop at 467 for targets of 445. And UBL, that's holding very well. The setup is slightly on the positive side. So UBL is a buy with a stop below 1600 for targets of 1700. All right,
Mitesh, thank you very much for that. Stay with us because we'll keep coming back to you because it's a day where, lots is happening in the mid and small cap part of the market. But thanks for that for now. Now, the Reserve Bank of India has approved the appointment of Ashok Vaswani as the new MD and CEO of Kotak Mahindra Bank. This decision comes as a big surprise. Abhishek is here. Why? And of course, more on this important story. Abhishek, over to you.
Well, Ashok Vaswani's appointment as the CEO of Kotak Bank is a significant development at Kotak Mahindra Bank. Here's some more information about him and the implication of his appointment. Now, who is Mr. Ashok Vaswani? Ashok Vaswani is a well-qualified and experienced banker with a career spanning 35 years. He holds a chartered accountant degree and a company secretary qualification as well, along with the executive education from Stanford. His notable career achievement includes that he has served as CEO of Citigroup's operations in the Asia-Pacific region, showcasing his extensive international banking experience. Now, Vaswani also holds or has held actually the position of CEO at Barclays Bank in the UK, demonstrating his leadership in a prominent global financial institution. He went up to lead Barclays Global Consumer Corporate and the payments businesses as well, indicating his expertise in various banking sectors. Presently, he is the president of Pagaya Technologies. Vaswani's current role in the fintech sector as the president of Pagaya Technologies, an AI fintech company with operations in both the UK and Israel. So, internal contenders for the position, there were two internal contenders over there for the position of CEO of the bank, which were Shanti Ekambram and head of consumer banking, as well as KVS Manian, the president of global transaction banking. However, Ashok Vaswani was selected as the top-notch person for this job. So what is in stake for Kotak Bank? Now, Kotak Bank has a strong retail franchisee and a significant market share in the deposits and advances. It has a lower stress level when compared to its peers, especially in the restructured portfolio or the SMA outstanding, and is challenging including the addressing declining of the low-cost deposits as well and competing with emerging fintech competitors. Now, expectations from the new CEO is that the top management at Kotak has said that they have expressed expectations from Ashok Vaswani. Uday Kotak has said the founder aims to bring a global Indian home to drive Kotak's and India's future. Now, Prakash Apte, the chairman, is confident that Vaswani will accelerate change and drive growth. Now, Deepak Gupta, the managing director and CEO currently, emphasizes Kotak's vision to transform into a tech-enabled, customer-centric financial institution. Now, analysts have given their perspective as well. Analysts say that they have varying opinions on this appointment. The choice of CEO is likely driven by the need for a push, for tech transformation in the bank, which is in line with industry trends as well. However, Vaswani's limited recent exposure to Indian ground realities could be a drawback as the banking landscape in India is quite unique. Now, convincing the current team to embrace change will be a challenge. Vaswani has a limited runway as CEO, considering there is an age gap of about 70 years in the banking sector. So overall, the banking sector will be closely watching the transition under Ashok Vaswani's leadership as Kotak Mahindra Bank aims to stay competitive and adapt to the evolving financial landscape. Back to you.
All right. Okay, Abhishek, thank you very much. That was a pretty in-depth piece there. Now we know the man in, almost entirety, whatever you can understand at least in public life. Thank you for that synopsis. Dipan Mehta, Director, Lexer Equities, is joining in. Dipan, good afternoon. Great to have you on the show as always. I'm not going to talk too much about just today's market reaction. Yes, there is that fear around net interest margins. I think that's a fear in general for most lenders. But what's your overall stance on Kotak Mahindra Bank as it's going through such a major leadership transition?
Yeah, good afternoon and thank you for having me on your show. I think that, this was to be expected and investors have been pricing in this uncertainty. And the fact that Mr. Uday Kotak resigned before his term, I thought was very well received. He's still around, so the succession will be extremely smooth. But overall, Kotak Mahindra is a very safe lender, and it starts to do well only when things get very sticky in the banking sector. But right now, I think some of these smaller banks and NBFCs are displaying far higher growth rates. And also the interest is more in small mid-cap stocks. which is why we are finding Kotak and Axis Bank, HDFC Bank underperform. And that may last for some more time. Also, these companies have got a lot of FI holding. So whenever FIs come to sell, these are the companies which are targeted first. So from a longer term perspective, Kotak Mahindra Bank and its peer group will create exceptional value. But I think the medium term prospects appear to be slightly weak as compared to some of the other banking stocks.
Dipan, afternoon. What have you made of this broad sell-off that we're seeing in the broader markets? It's quite a rout in individual stocks now. What's the genesis of it? What's troubling? What have you picked up from market participants like yourself?
Good afternoon, Rima. I think I'm not at all surprised. A lot of market experts on your channel and who I've spoken to have been quite negative on small mid-cap stocks. Valuations had reached uncomfortable levels. Not bubble territory, but they were quite rich. And a lot of retail investors, maybe even weak hands, trading positions had gone to a lot of small mid-cap stocks. And this kind of a shakeout is very positive for this multi-year bull market, which is underway. Actually, this is just a minor correction. And if from these levels, the index corrects by 3-4%, individual stocks correct by 10-15-20% or so, that would be a meaningful correction, which we haven't had in a long time. The reasons, of course, are obvious. I think global markets not supporting. There's relentless selling coming in from overseas investors. And some amount of fatigue factor also does tend to come in. Also, I feel that maybe this earnings season is very important for small mid-cap stocks, which are trading at very high valuations. And minor disappointments over there also can lead to a big fall. So I think some of these sensible investors are lightening up their positions as well. But let's see if this particular correction gathers more momentum.
All right. Hi, Dipan. Good afternoon. Dipan, some of these corrections actually they give you a good entry point. Now, PVR was a stock that did pretty well, but that's down close to 5% as we speak. RBL Bank management sounded confident. The numbers look quite good as well. That's down another 4% approximately. And, a couple of other notable names. NBCC, I recall us talking about this maybe 7-8 years ago as well. It had promised at that time. It disappointed, but this time the street was giving it another chance. That stock as well is down close to around 7%. So among these, PVR or RBL or NBCC, do you think that any of them are providing a good entry opportunity?
No, not yet. I would just like to wait and watch. As I said, 4-5% correction is nothing intraday. It can get recovered also. But 15-20% correction, well, that would certainly interest me. And then you look for good quality businesses, which are sustainable, which could, multiply or grow their earnings on a secular basis. And none of these three companies really, I think, fit that criteria. Of course, PVR may have a couple of great outstanding quarters, but, it's very dependent on content. NBCC is talks of bulging order book position, but the earnings always tend to disappoint. And on the whole, I think the quality of the construction also has been a bit of a question mark. So from that point of view, I want to avoid having invested earlier in it and not made any returns also. That's also kind of plays on my mind. And RBL Bank, I would prefer to go for banks which have had a more cleaner and a more, I would say, attractive track record. RBL Bank has certainly destroyed a lot of value in the past. So from that point of view, I want to avoid it. Although from a valuation perspective, it is extremely attractive and new management has come into play and things certainly have turned around. But apart from valuation, I don't see anything which is so attractive in RBL Bank at this point of time.
Okay, Deepan, stay with us. We'll come back to you in just a bit. Have to take a quick commercial break here. But on the other side, we'll talk about Laurus Laboratories and Ipca from the pharma space. Stocks are seeing moves, and there is so much more stuff. By the way, the Nifty is down 130 points now, so just above 19,400. Stay with us.
Welcome back. The Nifty is once again at the day's low, skirting around that 19,400 mark. That attempted recovery about 30 minutes back has again been sold into, and now the selling pressure is coming in from the banking names. Pull up the Nifty banking index. It was managing with about a cut of about 0.2, 0.3%, but the sell-off there has picked up. There you have it in the last 10 minutes, and that's putting pressure on the markets. The Nifty again is at the day's low. Midcaps too continue to sell off. The Midcap index has now extended its loss to about an 800-point fall. One of the stocks which has gotten punished today is Laurus Laboratories. Well, they came out with their numbers on Friday during market hours, but we got a lot more detail over the weekend, brokerage outlook. We chatted with the management. Ekta is here to give us the synopsis of that. Ekta.
Well, I'll start with one of the key disappointments for Laurus Labs, where the margins have still come in at around 15-odd%. Yes, there was a Q-on-Q improvement which took place in the margins, but it was still disappointing at multi-quarter lows. So in terms of what the management has guided, they have indicated that higher sales will aid margins going forward. They were quite positive with regards to the gross margins, which have shown some amount of stability, and gross margins will remain similar according to them. In fact, they expect higher sales in the second half, which will aid the EBITDA performance. Now, in terms of guidance, they have not given any specific guidance for FY24. However, they are confident on the second half being better than the first half when it comes to both revenue as well as EBITDA. There were factors such as a higher depreciation due to capex, which really weighed down in terms of the numbers. Overall, however, FY24 is expected to be a year of consolidation, but second half could probably see some more of a pickup. Now, ImmunoAct, that is the company which is an associate company for Laurus Labs. It was in focus a couple of days ago, simply because they have launched the first CAR-T therapy in India, which is approved by the Indian drug regulator. So on ImmunoAct, they said that it is currently well funded. They are helping them scale up. They are not looking to hike stake as of now, and not looking to buy out ImmunoAct as of now either. No plans for that. Overall, brokers are still disappointed despite the fact that the company is more confident about the second half. Jefferies has an underperformed with a target price of 260. They've cut the FY24-25 EPS by 33% and 5% respectively, and are 11 and 30% below consensus. Kotak sell, target price 270, insipid performance according to them, with a big miss across most segments in Q2. And Incred has a reduce with a target price of 307. They've reduced their FY24 and 25 estimates as well.
Ekta, thank you very much for that. The stock is at 365. The 52-week low on the stock was 278. So about 25% lower from where we are right now, which was hit when the company reported their Q4 numbers. And as Ekta said, it's the fifth consecutive quarter of a miss. Dipan, do you get the sense we are closer to the bottom, the end of the bad news, and things from here on will improve? Is this a good time to buy, or you would still stay away?
See, I think it's a great company and it's got very good manufacturing strengths. Some of the molecules, it is a market leader, and it's more or less completely integrated, so it captures the entire value chain. It's just that for some reason or the other, the performance has suffered, and this time the base effect also caused a lot of damage to the year-on-year earnings growth. I sense that it is reaching a nice zone where one can look at it seriously in terms of buying with a kind of a longer-term view. Because pharma industry per se also is recovering pretty well. The price cuts which we saw in US generics market and globally, those also have recovered. And who knows, maybe a few tenders here or there can make a difference for Laurus Laboratories. It's a quality player, one shouldn't dismiss that. So I feel more or less that it's coming to a level where one could look at it as a value play.
Okay, all right. That's about Laurus. We're going to get to Ekta to tell us about IPCA, but just hold on. I think we need to do a market check because the Nifty has now broken that 19,400 odd mark. And what's changed in the last 10 minutes or so is the Nifty Bank that was doing a relative outperformance. It was down only around 100 points. Now that's down close to around 210 points. So the intraday chart of the Nifty Bank should come up for you. And stocks like IndusInd Bank that were holding up in the green, that's moved into the red. HDFC Life, I recall that was one of the few stocks that were trading in the green. That as well has moved to the low point of the day. And now ICICI Bank as well is looking a little bit nervous, So that's given up some of the gains that we saw earlier today. Add to the list something like an HUL. That was one of the stocks that had opened up in the green. That as well has slipped. And the reason I'm highlighting some of these names is because they are larger weights on the index. Explains why we're just below that 19,400 mark. But let's talk about a couple of stocks that are doing well. Ipca Laboratories, they've got a booster shot coming from the US FDA, a clean sheet for its unit. After a long while, Ekta joins us to tell us more. Ekta?
Well, yes, definitely a boost for Ipca Labs because the US FDA has classified their Ratlam facility, which manufactures APIs, as voluntary action indicated in its establishment inspection report. Remember, this particular plant was inspected in June of this year and was issued 11 observations. It already has an import alert pending since 2014-2015, along with 2 other plants of Ipca Labs. So now, with an EIR, with a VAI, which probably gives the green signal for them to manufacture from that particular facility, indicates that there is a likelihood that this import alert is now lifted and they can manufacture completely for the US markets from this particular plant. It is positive for them because, like I mentioned, these are long-standing issues that they have had on this facility. Now, the street will wait by to see what happens for the other 2 plants. The other 2 are 2 formulation plants. One is in Pithampur in MP and the other one is Piparia and Silvassa. Both of them have also issued an import alert in 2015. Nomura has a buy and a target price of 11.33. They've indicated that the Ratlam side VAI classification is a positive surprise. So it's a big relief. Let's see what happens to the other 2 facilities. But for a plant having a positive signal from the US FDA after having an import alert on the facility means that they have managed their compliance successfully.
Okay, thanks a lot for that, Ekta. Well, you have only 280 stocks that are trading in the green, and this is one such stock that's up close to 7%. Deepan, Loris, you believe it's coming to that attractive level. What about this one? You know, this is a booster shot. Good to see things getting cleared out, but it's already up close to 7%. Your view on it?
No, I think very positive for Ipca Laboratories and shareholders as well. And this could, take the company back into a new growth phase. Already, I thought the management had done pretty well in terms of diversifying their revenues and still managing to grow despite the ban on sales to US generics market. But now that hopefully is getting lifted, make a big difference to the top line, bottom line. And it's coming at a good time when we are seeing that price erosion in the US generics market have kind of eased. So very positive on Ipca Laboratories. Valuations also are not that rich at this point of time. And on the whole, we are positive on pharma stocks. I think this quarter numbers will be exceptionally good. So from that point of view, one could certainly look at Ipca from a trading perspective as well as a long-term investment idea as well.
Okay, all right, got that. Deepan, thank you very much. It's been a pleasure having you on the show. Thanks for joining in, and you have a good rest of the day. By the way, just want to point out that this sharp drop in our market on the Nifty itself, that's coincided with a sharp drop in US futures. They were looking better off, but now, for instance, NASDAQ futures are down about 0.4%. S&P down about 0.3%. So it's looking a little wobbly in terms of the expected start on Wall Street as well. That explains the fresh round of selling that we're witnessing here. It's a bad day for the bulls. There's no other way of looking at it. We'll take a break. On the other side, we get you more market perspective. Prashant.
The US 10-year is above 5%.
Yeah.
I think that's, I don't know, I didn't look at it earlier in the day, but I think
it was
now...
it was just below at
exactly 4.8 or something till about 20 minutes back.
4.98 about 20 minutes back. So just before getting into closing that, I was looking
so when
at
we start, I think we left off at about 4.92, 93 or so, 94 I think on Friday, and now it's back above that. You want to call it but 5% is 5%, right? 4.99 is still under 5, but this is interesting. And, last week was extremely significant with the 30 basis point jump Friday to Friday in the US 10-year. So we are above the 5% level on the US 10-year.
And that explains, I think, the sharp drawdown on the equity futures market.
Yeah. What you mentioned, the NASDAQ down sharply, and not sharply, but incrementally it's sold off. And I think the pressure here as well. Of course, to boot, it's a market holiday today. So when you come back day after, you'll be reacting to 2 days worth of change from the US. We'll take a very quick break here. We'll have Siddharth Bhaiya, Managing Director and Fund Manager at Equitas Consultancy on the other side, someone who has a view on mid-caps and small caps. Not a positive one, though. We're back with him in just a bit. Okay, if you're just joining us, the markets, I think, extended some losses. We're down sharply, actually, 170 points. And we'll have a flash up at the bottom of the screen, which basically tells you that the US 10-year, the 10-year yield, that is, has hit 5% for the first time, I think, since 2007. So that is the new information which we are getting. We were a couple of basis points we were discussing for most of the session today in Asian trade, but I think we now crossed the 5% mark. And of course, a lot of the reasons why yields are 5 or perhaps even head higher, it's not as if things are going to flip around and change very much very quickly, although one may hope and want that to happen. But more and more, consensus and market consensus really seems to be veering towards the fact that maybe it's not just 5, but maybe a little bit more, and then we stay there for longer than what would one expected earlier. I mean, that's the global risk-free rate, which basically around which most of the other financial instruments are anchored.
By the way, the BSE small cap index is down 3.5%. The Nifty micro cap 250 index is down 4.5%.
So I think, Rima, along with the sell-off in the Nifty, etc., the mid and small cap part of the market is also sold off more once that happened. There you go. The 5% there on the 10-year, and I think mid-cap's also the similar kind of fade. So yeah, this is now looking more serious. It was some signs of recovery earlier on, but all that has been kind of sold into. Let's welcome in Siddharth Bhaiya, Managing Director and Fund Manager at Equitas Consultancy. Siddharth, good afternoon. Great to have you with us here. Siddharth is someone who, across schemes, his PMS, his AIF, his offshore fund, invests mostly in mid and small caps, and he's got a fantastic track record over the last 10 years or so. So he's made a lot of money for people who invested with him. So, of course, he likes the space, but maybe he does not like the space right now for the moment because of how well they've done. Am I sort of paraphrasing your thoughts correctly, Siddharth?
Perfectly well, Prashant. Hi, Prashant. Hi, Nigel, Surabhi, Rima. Good afternoon to you guys. I think, Nigel, Prashant, I've been in the markets for nearly 20 odd years. I've read history for more than 200 years. And trust me, what I see on the valuation front, I've never seen anything like this before. Or I've never read in history that valuations have been so high for such a long period of time. In history, you've had times where you've had bubbles where PE multiples have gone to 100, right, for a very short period of time, whether it was 99 or whether it was 2007 or even before that. But nothing like this, right? 50 and 100 PE multiples have become very, very common. So, and as I said, we're all worried about one day, which is today, but look at what the indices have done in the last 6 months. The small cap index is up 30%.
Siddharth, hi, good afternoon.
Hi,
fair enough. Your caution is well understood. So you really think that we in the mid caps and small caps are in a bubble zone? Are you steering clear then of this side of the market?
So I've always been a small and a mid-cap investor, to be honest with you, right? And all I want to tell you is, say, 3.5, 4 years back, it was a very narrow market where only maybe 15 or 20 stocks were doing well. And today you have a complete opposite where every junk stock is going up. You look at what is happening in the IPO market or in the SME market. So that kind of scares me. So yes, right now I'm worried, but this is my abode, so I've always been a small and a mid-cap investor, and I'm always going to be that.
Hi, Sid. Good afternoon. I like the way you put it a few days ago. You said that, management gives commentary and guidance for 2030, but the stock market wants to discount it on that day itself. And the stock goes rocket up. And today, in fact, some of that catch-up is happening because people are a little bit cautious today. Maybe it's a few days phenomena. But there is clearly some kind of catch-up. So tell us, what do you do then, Siddharth, from here? Now, I'm looking at some of your stocks. They've been big winners. Stocks like Apar, Power Mech, Technocraft, Jindal Saw, Jindal Stainless. These are 10 baggers, I think, in the last 4 years, most of them. So if we do see a correction, would you look to deploy in some of these holdings that you already have, or the buy stage is over? Now it's time to hold.
See, to be honest with you, these guys, these stocks have run up more than 10x, as you pointed out. Yeah. Right? They've been big contributors to our portfolio. So we would hold these stocks rather than buying at these levels. So clearly, I find very few stocks which are within our buying range right now. So we're holders. We believe, the infrastructure story is going to do well over the next 7 to 10 years. But do I see? As I said, I'm really, really worried about what is happening outside, in the broader market. And if there's a sell-off, then nothing is going to be spared. So yeah, I'll be cautious. I'll be very cautious as far as deploying money is concerned.
Currently, I think 5%.
So we're cautious as far as building portfolios is concerned as well.
All right. So that then 5% of your portfolio, I think, is in cash, right?
Yes.
So you won't be deploying that. But would you look to raise cash if you're going to be in for a rougher ride?
No. Again, as I said, Nigel, we are very long-term investors, right? We are more than happy to ride this correction. We could have taken a call for cash maybe 2 years back. And since then, our portfolio is up 300%. So we don't take very short-term calls. The valuations for our stock, see, we are value investors. So we still find that our valuations are not extremely frothy. Yes, they are outside our buying range because we want to buy stocks at single-digit PE multiples. But I don't see any reason to sell them. The long-term story as far as the sectors in which we are present is, it's kind of ironical that I'm saying, I see a lot of froth, but I don't see froth in my stocks, which probably every fund manager says. So, but that is what it is.
There is no stock in your portfolio, Siddharth, which you're tempted to sell?
Any stocks I've already sold wherever I am.
So do you want to tell us the stocks which you've sold recently?
So we would have booked some in the top 5 names that you're looking at. We would have booked some profits over there.
What would, Siddharth, what would the average PE of your portfolio be now? I mean, is that is a okay measure to look at?
Yes. So probably now on a forward basis would be something like 12 times earnings.
Oh, wow. And that is serious stuff. So
again, as I said, Prashant, the lessons of valuations have been forgotten, and the markets are going to teach people some harsh lessons as far as valuations is concerned. I don't know when.
So 12 well put, 12%. 12 times 1 year forward.
FY25.
Of course,
FY25.
FY25, and you are someone who has a track record to maintain and uphold. So, and you're a value investor, but you like growth, right?
Yes, yes, obviously. Yeah. See, again, as I said, you look at these 5 names.
Yeah.
If you go back to, say, these stocks had not done anything from 2007 to 2020. In fact, a lot of these stocks had negative returns for a very long period of time. Completely ignored whether it is the cap goods sector, or whether it is the global commodities, or whether it is media. We've discussed media also before. So I think cycles last over decades. We're talking about, say companies in the B2B infrastructure lending, financial services. Nobody remembers an IDBI or an IFCI, or whether the erstwhile ICICI. So I think a lot of these, cycles will play out over the next 3, 4, 5 years. And the winners of the past will be forgotten. And cap goods is not a bad name anymore. But when we bought them in 2020, right, nobody even knew these names.
Yeah, so that's very, very true. New winners emerge in every boom cycle. But I must, completely with you on that. Nobody thought that capital goods will make the comeback that it really did. So let us ask you about this one question. Since this is a pocket that you have owned, you understand the valuation metrics as well. I think the problem that a lot of investors are grappling with now is that they understand the fundamentals are in place, and perhaps it is a multi-year cycle this time around. But how do you wrap your head around the valuations? Because stocks have already run up. So what's a good PE to buy engineering or capital goods stocks at now?
So Surabhi, the day they get the quality tag and 100 P is acceptable is probably the time when everyone will enter this space. So I've seen these cycles, right? FMCG stocks used to quote at 10, 12 P multiple way back in 2004-05. And today they all quote at 100 P multiples. So you have to have a new breed of investors who at some point in time will come and say, oh, these are 100 P stocks and they should get 100 P. So we'll see. There is some way to go. Am I buying at these levels? Clearly not. Am I holding? Yes, I am. Because I see a lot of visibility over the next 3, 4, 5 years. Infrastructure is a need of the hour. It is not a luxury for our country, right? You look at telecom, you look at airports, you look at railways, you look at defense. We need that expenditure. And my sense is that the government is going to crowd out the consumer. So last 10 years were more about the consumer. Next 10 years is going to be about B2B investing. We're very bullish on manufacturing as well.
Okay, we have your top 5 holdings: Apar, Power Mech, Technocraft, Jindal Saw and Jindal Stainless. Do you want to go a little down the list, where in terms of your holdings, the stocks that you hold? Because we're very, interested. Your PE is only 12x. So do you want to tell us some more of your holdings? And when you booked out of these names, at least partial profit booking, what did you do with that money? Did you use it to up your cash levels to 5%? Or did you reinvest it? And if yes, in which names?
So Rima, something like Apar Industries have been holding for more than 10 years now. Whether it is Jindal Stainless, Jindal Saw, right? We are holding for more than 7-8 years. So our holding periods are much Our focus is on getting the buying price right. Typically, we would want to buy stocks, very good companies and with good balance sheets when they're kind of, factoring bankruptcy. Like we bought a couple of print media companies a year back, and they were available with 50% net cash on the balance sheet and 3 and 4 P multiples. So that is again, people said, print media is a dying industry. And today we have the front 8 pages of any newspaper filled with advertisements, and most of it is IPO companies, which are, companies which are planning to come out with their IPOs. So I think what we want is industry leaders. We want them when they're completely ignored. We want them at bankruptcy valuations. And typically, and you kind of get it. Do you get it every day? No. Maybe you get it once in 6 months. But we are like Warren Buffett. We are ready to wait for the fat pitch or the full toss.
All right, Siddharth, a lot of our viewers would like to know where you'll have gone ahead and increased stake, maybe a fresh entry in a particular company or doubled up on a position. So give us a couple of ideas.
So as I said, in the last 1 year, we've increased we've added exposure to the media sector. We've also added financials for the first time, and we've looked at B2B financing, institutions which are focused on financing infrastructure and capex in the country. I leave that you and your viewers to figure that out. But and we're very selective, Nigel. We're very selective. We will not add more than 1 to 2 stocks per quarter. That's the maximum.
So, we had when you talk about manufacturing, right? The poster boy of manufacturing in more ways than one, because it has its hands in so many different businesses, has been CG Power, right?
Yes.
Power, industrials, and others as well. But again, I mean, valuations are it's not palatable, I don't think. Just comment on that business, if you will. I mean, it's a...
See, again, as I said, we've been fairly early investors in the power sector as well, whether it's cables, whether it is this. And some of the valuation, the stocks have run up quite a bit. Our thesis was the same, that for nearly 13 years, you had no investment as far as the power sector was concerned. The world spent nearly 5 trillion on renewable energy, and post-COVID, everybody fired up their thermal power plants. So India, I feel, again, as I said, I don't want to put out a very negative view as far as the Indian economy or this is concerned, right? We are in a sweet spot. If you look at any other economy in the world, whether it is the US, Europe, Middle East, China, I think we are better placed than anyone else. And we had manufacturing in India is going to do well, right? Today, I think there was some news around Foxconn that the Chinese government is investigating, a supplier of Foxconn for evasion of taxes. So people would, global companies would want to set manufacturing facilities in India. And I don't think so. It's going to be a bear market. But yes, there's going to be a correction as far as some of the valuations are concerned.
Siddharth, from micros and sectors, slightly pulling back to the macros. You like reading financial history, and you looked at data going back 200 years, as you said, right? You've never seen valuations. As they say, right, interest rates act as the gravitational pull for valuations, right? Equity multiples. Yes. And as we speak, you've got the US 10-year, which is now topping 5%. Yes. Any thoughts on that if you want to weigh in at all?
I think Prashant, multiple times I've said, right, that from 1979, when the US Fed rate was at 12-13%, for a 35-year period, more than that actually, you had interest rates only go down. people have no idea about higher interest rates. And as interest rates went down, asset prices went up. And then you had, unbridled money printing over the last decade. And that also led to, further increase in asset prices. So this is a bubble of epic proportions as far as valuations are concerned. I really don't know. Economically, we will do well, but I don't know when, how this corrects. But it is the correction. Financial markets are not about the last 10 years or the last 20 years. Financial markets are about 100 years, 300 years, 500 years. It is about human behavior, which doesn't change. So people haven't seen average interest rates in the US before 1979 have been north of 5.5%. This is the average interest rate. So why are we worried about a 5%? If you are a retired person, or if you are a person who's invested in fixed income, practically for the last 30, 35 years, you've not earned anything on your fixed income portfolio. So naturally, even if you're a fixed income investor, you move towards riskier assets.
Yeah. So that a great conversation and great to speak with you. It's refreshing to speak with you because you kind of bring in the historical context as well, because I think that is sometimes missing in these conversations, but you brought it out very well. Thank you so much for joining us. And,
Thank you. Thanks a lot, guys. Bye-bye.
Thank you. Thanks very much. All right. Well, I think the markets, by the way, taken another leg down. We're down, I think the last we checked before we sort of were joined by Siddharth, the Nifty was down just under 200 points. We're down 250 points now. 19,300 is gone on the Nifty. And look at the sharp cut once, that 5% number on the 10-year came through. So it all started at about 215, exactly at 215. With the Nifty, let me just actually pull the Nifty up. Yeah, the Nifty was at 19,440, and we've given up 140 odd points in the last 30 odd minutes of trade. More than that, actually, last 45 minutes of trade, because it's now past 3 p.m. So this is looking ugly. The Nifty Bank, by the way, is also down about 1.25%. And similar kind of picture. Here, the sell-off started at about 155, a little earlier as compared to the Nifty. But again, it's been a vertical fall on the Nifty Bank as well. Nigel.
Indeed. And the last 20-25 minutes or so, it's predominantly because of the Nifty Bank. And just one more point I want to make. The Nifty Bank is now down close to around 500 points. And it's bang on the 200 DMA. So if you're looking for an important technical level, well, this is it. 43,194, that's the level. We breached that intraday. And now, in fact, now we're seeing a sharper cut out there. So we're 550 points down. The Nifty Bank is the culprit for the last 30-40 minutes or so. That's still nosedived, and that's what's put pressure on the Nifty as well. And that's why instead of 19,500, 19,400, now the Nifty is up at 19,300 mark. We'll slip into a short break. You come back, we'll get Nimish. He'll give us an insight into D-Street chatter, and we'll also get our technical experts back with us. Welcome back. Well, the markets have taken a deeper dive now. We're down closer on 270 points on the Nifty itself. But let's try to find out what's going on in dealing rooms. Nimesh joins us. Nimesh, tell us first up, what are you picking up in terms of D Street chatter?
Nigel, not looking good, right? I mean, it's an ugly looking screen. The mid-cap index have fallen. Small cap index is down more than 4%. Macro cap index is down 4.5%. And on Friday, there were first signs of some bit of panic in the broader markets. And today, it's a sign of capitulation. Clearly, a lot of mid-cap, small-cap stocks are down 10, 15, 20%. The breadth is quite weak as well, right? Advance decline ratio is quite weak.
Yeah.
But, again, the feedback is that in many of these mid-cap and small-cap, the fall is not on very large delivery volume. So that suggests that this is not led by institutions, but it's largely led by the retail and HNI investors. And it looks like more of unwinding or a forced selling, so to speak, by the retail investors in the broader market. So that explains a bit of pain in the broader market, so to speak. In terms of flows, again, it's a mixed year, not much from the buy side, from the large institutions. But I guess it's the financial, which is again a pain point. But what I observed in the last half an hour of trade was once we broke that 19,450 on the Nifty, there was a very strong support from a technical perspective. Once that got taken out, we saw a sharp vertical fall across the market. And now the next level to watch will be 19,250 on the Nifty. If that still get taken out on the downside, then it will open up a big, kind of selling pressure in the broader market. So that's overall feedback. The bigger pain is in the broader markets. Looks like it's a bit of a capitulation, but it's largely retail driven.
All right, and we're almost there actually. 19,250, just 20 points away. And for the Nifty Bank, we have broken the 200 DMA.
Yeah.
So that's a bit of an issue. But before we get to the stocks, Nimesh, a lot of HNIs. You mentioned that a couple of times.
Yeah.
Did you speak to a few of them? What is the feedback you've got?
I did, Nigel. For a change, I just wanted to understand what the larger HNIs are doing. So I just did a short, dipstick with some top 5 large investors, large HNI investors. One is, heading a family office. One is a super alternate HNI investor. They manage their own personal money as well. So whole host of HNI investors who are very active in the market. And the overall feedback was very simple. One, the correction was long overdue, right? We've been saying this for a long time. The India market was actually ignoring a lot of the global weakness. So that seems to be now catching up in the broader market. So that's the first feedback. The other big feedback was don't just get carried away and try to buy the first fall.
Correct.
So nobody's willing to buy in today's fall for sure. There is a feedback that maybe you can see further sell-off, another 15, 20, 30% as well in many mid-caps and small caps. And the only reason is valuations. The valuations in many of these companies are just not justifying the kind of rally we've seen in many of the broader market stocks. That's the feedback as well. The other sign is the sentiment. If you look at today's market, the good news, the good numbers got sold into. That are signs of that there is now the sentiment is strong for the weak as well from the larger community. And what are the risks for the markets? We've been ignoring for a very long time, but global risk off is clearly there. Your 10-year is at 5%. Remember, November, December will be a 5-state election, so that outcome could be very crucial for the markets. And also, the earnings are not that great, right? I mean, we've seen some positives, but at the margin, the earnings have been quite average. So valuations are stretched and earnings are not supportive. So these are the reasons why there are massive headwinds. So the one-line message is it's a first signs of a fall. Don't try to capture the fall. Don't jump into it. Wait for it and look at valuations and then look at buying into this weakness.
Okay, all right. So we have got the institutional flows, we've got the HNIs. Now tell us about stocks, because they continue to do the thing of their own. What have you heard?
So in terms of individual names, the first stock on my list today is Indiabulls Housing. It's a trader's delight. A lot of traders punt into it. Big sell-off in today's market and on good volumes as well. I believe in fact, on Indiabulls Housing, the feedback is maybe one of the strategic holder who owns close to 3.5% stake in the company. They are the likely sellers in today's fall. So that explains the big fall in Indiabulls Housing today. The second stock is JSW Energy. Despite good numbers, that stock is under pressure today, and some sell-off as well at the HNI desk. And in JSW Energy, the feedback is that maybe watch out for some corporate development in the near future. There could be some management rejig as well. Remember, with the results, they also announced a new COO. So further changes at the top level is something which needs to track in JSW Energy. The third is a combination of auto names, TVS Motors and M&M. While there's a lot of sell-off in a lot of the mid-cap and broader market stocks, these two stocks, TVS and M&M, stands out purely on buy flows at FIDS. So it's not like it's a one-way sell-off across board. There is buying as well, and this to stand out purely on buy flows from larger FIs. And the last one is IndusInd Bank. Again, we saw a bit of momentum on hopes of MSCI inclusion, but now there is clear selling pressure for the second day running. The FIs are net sellers, so expect high delivery volumes in IndusInd Bank in today's trade.
Okay, thank you very much for that. The bears have tightened their grip on the markets well below 19,300, and at least today there are no buyers. No one wants to buy the first dip, as Nimesh pointed out. They'll wait to see how this plays out, particularly since there is global turmoil. Mitesh is back with us on the show for a few BTST calls. Mitesh, you've been bearish on the market. Do you see things getting worse from here on? What would be some key levels on the index and then your stock calls?
In fact, when the show began, we were at 19,430, and I said we might actually head towards the August lows of 19,230, and we're practically there, 50 points away. And the Bank Nifty is also now trading just at the 200 average of 43,190, 10 points give and take, and we actually breached it during the day. So I think the overall setup is negative. We will see more declines once we get a closing below this 19,230 to 200 zone on the Nifty, or 43,180, 150 zone on the Bank Nifty. And then I would look for about 18,900, 950 as the first target area for the Nifty, and levels of around 42,200 is what I'll pencil in for the Bank Nifty. So the overall setup is negative. I have in fact two sell calls or STBTs. Z is breaking down, trading at a fresh swing low. So Z is an STBT with a stop at 253 for a target of 242. And AB Capital is another one which I would recommend taking a STBT position with a stop at 175 for a target of 168.
Okay, plenty of sell calls, and there's no let up. Thanks, Mitesh, very much for that. No let up. It's just like this incessant waterfall. The Nifty I'm talking about, not the Midcap index now. By the way, the cut on the Midcap index is well over 1,000 points, an 1,100 point fall on the Midcap index. The Nifty itself, levels are just going. Prashant, I hate to use that phrase, falling knife. It's such a cliche, right? But just the manner of this decline is just not stopping, and there are 10 minutes to go.
I was looking at the Fin Nifty because I think there is expiry today as well. The Fin Nifty 19,500 put. Basically has jumped I think almost about 450 times in about 14 minutes. 450 times. It went from about 35 paise to I think around 153 odd rupees or so. So it's been rapid. I mean, the repricing has been rapid, as suddenly there is a bit of a panic which has gripped the street. So that's what I'm talking about, the Fin Nifty index. And of course, on the option side, the action. So yeah, I mean, it's looking pretty horrible. And let's just take a look at the mid and small cap indices before we take a break. The mid cap index is down about we're at the day's low. I mean, so there is nothing to 2.8%. And when we began at 215 today, a little earlier than usual, I was saying that how at that point, I mean, it was not looking comparable at all to what we saw on the 12th of September when the indices sold off 4% each. But now perhaps the situation is a little different with the cuts that we have on our hands. Yeah, the small cap index is down 3.8, which is also now at the day's lowest point. 250 stocks are higher, and 2,000 stocks, 10:1, is the declines to advances ratio overall that we have on our hands. And so many stocks now, basically at the lower end of the day's trading range, 5, 10, 15% cuts coming through. All right, we'll take a quick commercial break here. We'll talk more markets on the other side, but there's only about 8 minutes to go for market close as well. I'll be right back.
Welcome back. You're with us on Closing Bell, and we have been witnessing what's been a pretty weak session for trade. Weak would be an understatement. Down to the final few minutes, we have Amrish Baliga joining in. Amrish, your thoughts on what you've made of this decline, and if you'd like to buy something. You know, there's a sale on in the market, Dussehra or Diwali sale, perhaps I can say that.
Yes, Surabhi, I mean, if you see the last couple of months, it was basically liquidity which was driving it. Surely the news flows and earnings were better. But then the valuations, especially for mid-cap and the small caps, had become quite steep. And if you see the last 6-7 months, we've seen so many multi-baggers among this flock. So basically, it needed a reason to, to correct or fall. And it could have been somebody sneezing. And right now, we can blame it possibly on the U.S. Treasury, yield spike. We can talk about the war, widening, that fear, oil prices going up, possibly supply chain disruption. There are a number of things you can blame on, but I think basically it is that tiredness post that huge increase in valuation. And since it was liquidity, it was driving it. On the way down, I think the liquidity can dry up. And exactly what we are seeing today. And because of which we could see the fall further. Because the way I see it is at the Nifty level, at least possibly a 5% to 6% fall, I think is very much possible, which means the individual stocks, especially the mid-cap and the small caps, can fall much more. I'll not be surprised if you see 30-40% fall in a couple of these small cap or mid-cap stocks. So one has to be a bit careful at this point in time. But despite this, in fact, I have a buy call. The company is Schaeffler India, which is basically into development and manufacturing of high-precision roller and ball bearings for automotive as well as industrial. And also, railways is a major focus area for them. So in automotive, its products are across internal combustion engines, hybrid and fully electric drives. So clearly future-ready. And in the automotive after-market segment, they are clearly focused on the spare parts business. And if you look at industrial, they are there across various sectors such as cement, power transmission, mining, wind, agriculture, and industrial automation. And going ahead, the management has guided that the EV business would be a key driver. So with, in fact, a higher content per vehicle. And the company has managed to improve its performance in the last few quarters, which was aided by the automotive and industrial segment recovery. Expecting an EPS of about 110 for calendar year 25. And my target price here is 3,850.
Okay, thank you very much for that. Counting down to what's been a very ugly day for our markets. The bears have been in complete control of the markets. We've been in the red all through the trading session, but the sell-off only picking up in the last 1 hour as the US 10-year yield touched that 5% mark for the first time ever. It's just a number, but it's rattled sentiment. All over the world. The Nifty ends with a cut of about 275 points, a 1.5% loss there. The mid-cap index, small-cap index bearing the brunt of the selling pressure. It's near 3% fall in the mid-cap index and the small-cap index even more than that. Even banks participated. Banks were holding up resilient for a greater part of the trading session, but in the last 1 hour, we've seen the sell-off pick up in the banking names, and the Nifty Bank ends with a cut of about 600 points. And look at that advanced decline ratio. When was the last time we had one stock gaining for 12 stocks losing?
Yeah, absolutely. 2,800 stocks declining, less than 250 stocks advancing. That just tells you the magnitude of the weakness and the big fall that we've seen today. Almost everything in mid-caps is down. I'll just take some names for context. A lot of the government-owned stocks, whether it's central government or state government owns, they really came back down. SJVN 13%, GMDC 12.5%, stocks like ITI 10%, and then of course all the PSU banks, Bank of India, weak in trade. You had other names like NBCC down 8-9%. It's a long list of losers out there. Hindustan Copper, Ircon. Basically, the government-owned part of the market has been hit the hardest. But having said that, you have other names which have seen weakness as well. Vodafone Idea, JK Tyre, I was going to say non-government owned, but it's just government stocks. IDBI Bank, NMDC Steel, that's where the weakness is. Ujjivan Small Finance Bank on the private sector side. Very quickly, some result reactions. Lotus Lab, market is absolutely not convinced with the performance in the second quarter. Almost 10% of a knock on the stock. Amber's numbers didn't go down well at all. 9% gone over there. Paytm, despite profitability metrics improving quarter on quarter, Street's not too enthused. 7% down on Paytm. Poonawalla Finance, 7% down. even L&T Finance Holdings. And folks, I think that's the nature of today's fall. That I think L&T Finance, there was nothing specifically really wrong with those numbers, but I guess there was just no scope for error or any sort of confusion. But overall, just an extremely weak day.
Oh yeah, and you get one of these, once in a while. Last time, absolute shakeout, and this is the definition, because September 12th we got one. But then, after that sharp 4% cut, the market just moved on, right? So that's the only thing we'll find out when we come back day after tomorrow, is whether this is one of those, one day cuts and then the market moves on. And I think some clues we will get in terms of how US markets behave later today and, of course, tomorrow as well. So 2 days worth of US action to react to. We've been wondering here about valuations and how well the markets have done, but without any pullbacks. In some ways, that's been the situation in the US as well. People have been scratching their heads. So let's see if this is that time where things do start to reasonably pull off. Well, it's a wrap on this edition of Closing Bell, but don't go anywhere. Our special offering, Market Cafe, comes up next. Stay tuned.